Somebody's already putting one. Okay, all right, just a moment. That's good. All right, thank you, thank you. You can hear me, thank you. All right, I today's class will be a little bit. I must close this class in the next 40 minutes because I need to hit the gym. I need to go to the gym today. I go to the gym yesterday. I want to go to the gym today, so we're going to rush something in the next 40 minutes or about. All right, so I want to welcome you again to this class. We're not rushing the class because I want you to actually understand. My goal is I want you to see trading as a career, not as a gambling, not somewhere you just go to press phone, just press a buy, just press. I want you to actually understand. And to understand it, you need very strong foundation so that you understand when something, whatever is happening in the market, you have a very strong foundation about it. That's the reason I'm taking it systematically. You know, somebody a couple of weeks back, somebody said, you were asking me to teach strategy about trading. Is trading good or something? Trading a particular instrument. I said, you should apply for a master class now. He said, how long is your master class? I said 6 weeks. Take you 6 weeks to be in a master class. I said, how much? I told you the amount, and I was like, I just want something I can just learn within a week or two. Can't we shorten within a week or two? I said, no, we don't teach like that. I said, because when you go out there and you tell people that, oh, I learned forex so and so from Apit, that you must understand certain things. It's not just about quickly teaching a strategy, it's about laying foundation because we are creating brand. So it's not just about teaching somebody, it's about laying a very strong foundation. You understand the nitty-gritty. Even when you lose money, you know why you're losing money, and you know you will make the money back. You will know, you understand the market perfectly well. You know, sometimes when you see, losing is part of the game. And some people don't like to lose. I don't like to lose too. I don't like to lose. I don't like to, and that's why I take up time to master some instruments because I know I understand those instruments very, very well. Some of these instruments online, they have become like my family member. They become like my family member because I understand them much more than other instruments. I understand them much more than other instruments. There are instruments that if I start trading now, I will not get as much perfection as I will get in the other one that I've already mastered. So it's important we lay a very strong foundation. That's what I'm trying to do. So just stick with me. Just stick with me. See, market is always there. Market has been there before, most likely before any of us here is born. So market is still going to be there even when we are long gone. So relax, going to make money, going to make a lot of money. Okay. So let me quickly go to what I have for you today. And so we're already getting into yesterday I was talking about we have different kind of analysis, market analysis. Some use fundamental. They use the data. They use the economic data to determine their entry and exit in the market. Strictly fundamental. You can call it news. But me, I mean economic data. I mean the policy of a particular economy, how it will affect them. Because when you buy a currency of a country, you actually buy into the economy of that country. So we have people who are fundamentalists, people who use fundamental analysis to determine their exit and entry into whatever instrument they are trading. And then we have the technical analysis. And this is when you strictly use your chart to determine your entry and exit into the market. Okay, then we have the sentiment analysis, and I explain all that to you too. When you're just biased, you have a bias in the market. Sometimes just a little sentiment, not necessarily there is the data, but you just feel, just a feeling, just a projection, not it's just sentiment, and it's not really back up with the data. You just have a little sentiment, a bias, in the market, and sometimes it works. For example, now there's a way JPY functions at the end of the year. Maybe you don't understand that. There's a way JPY functions at the end of the year because people import more from China when the year is running to an end. I've studied that for a couple of years, and I know that there's a way JPY function when the year is running to an end. That it may not necessarily do like that at the beginning of the year or any other part of the year. So it's just so that's most like a fundamental, because so much importation from China happens toward that side. People are in a hurry. People want to buy this, want to buy that before the year runs out. Like that. That's still human behavior. And so now history repeats itself. Now I told you yesterday that one of the statements you should write down is that history has a way of repeating itself. So towards the end of the year, there's a repetition in history. Okay, something happened at the end of the year. Something happened at the beginning. For example, now personally, from December 15th to January 15th, I don't like to trade currency pairs. I don't like to trade. I don't like to trade. Enter from December 15, December 20, I close the charts. I traveled. Not just because I travel, because you see, market is unpredictable. People are given holiday. People are going on vacation. They are spending the money they've made from the beginning of the year. You understand? So history will repeat itself. So you discover that your analysis may not always correct between December 15, December 20 till January 15. January 15, people are just resuming to work. You understand? The banks are on holidays. The corporations are closing down, and then they are ending the year, and then the first 2 weeks in the new year, they are giving people break. People are returning at the middle of January, and the likes. So you need to understand that. You need to understand. So if you trade in that time and you are now losing so much, you will know that you are likely trading when there is little volatility in the market, when the banks are shut down, when people are on vacation, people are spending, they're just enjoying themselves and entertaining themselves, they are not trading. You need to understand that. So history will always repeat itself at the end of the year through the early part of January. The last 2 weeks in December, the first 2 weeks in January, history will always repeat itself. You need to note that in your mind. Okay, and then we also talk about different kind of trader yesterday. We have the scalper. These are the people that trade in a very short time frame. They don't stay long in the market. They are scalpers. They scalp. They 2 3 minutes they're out of the market. For example, we scalped today on gold. Sometimes you require to because we are counter trend trading. And then you scalp a few minutes in the market, they're out of the market. Then we have the day traders. The people stay a couple of hours, 3 4 hours in the market, 3 4 5 hours in the market, and then they make sure that the trade they open in a day, and then it's closed on the same day. It's closed on the same day. They don't cross over day to the following day. Or if at all it happens, it's just very few times they allow that to happen, and then that those people, they don't pay swap fee, so they enter. Those are day traders, day trader. And then we have the swing traders. The swing trader are the people that just follow the trend of the market. They follow the swing. When the market is buying and is buying and is buying, they don't come out of the market until the swing changes. Until if there is an uptrend in market, they will stay in that market until it begins to sell, until they've confirmed that the trend has changed. I'm going to be teaching you all of that. So we have the swing trade, and swing trading is very sweet, but though it requires being patient. It requires being patient with the market, and so you are not in a hurry to come in and come out under few minutes, under 1 hour, under 2 hours. You just take there with the market. And I was giving an example. I say if you have been trading gold since last year, by now you'll have been a millionaire, at least in Naira. You'll have been a millionaire. You must have had enough money to buy Ferrari. You must have enough money to buy Ferrari. Okay. So then the last kind of trader are the investors. These are the people who are not using the chart to determine entry and exit. They're using the data of a company they are investing in. They are looking at the management. They're looking at the prospect of the business. They're looking at the prospect of the business or the attitude and character of the founders. For example, one of the things that make Bitcoin to grow very well is because of the founders, the founding, the people, the early investor, people who invested in those coins. They are not lazy people. They will work. They will put. They will work. As in they will deliver the job. A couple of years back, there was this particular coin that came, TBC. TBC was rubbish. TBC, that the founders don't have sense. I'm sorry to say, I don't understand them. Oh my goodness. So so that's fundamental analysis. Those are investors who use the company data, the understanding of the management, the prospect of the business, and so many other data before they determine whether they're going to invest in that stock or in that pair or in that instrument or in that shares or in anything. Okay. All right. So let me take you to my chart. Let me share my screen with you. All right. So we started talking about, henceforth now, we'll be focusing on technical analysis now. Technical analysis, henceforth. Henceforth, technical analysis. Henceforth, technical analysis. My screen. But I'm excited tonight. If you can see my screen, please type 2 in the comment section. If you can see my screen, please type 2 in the comment section. If you can see my screen, type 2 in the comment section. All right. So now, hence, for the next couple of days now, our attention will be on technical analysis. Okay? And so in technical analysis, we are using the charts to determine our entry and our exit in the market. And now, the chart, I call the chart the market language. Yesterday, I was showing you the different kind of because it's the most updated, it's more details. It has more detailed information than any other market language that we have. Okay, so now you see on my board, you see candle. This is the candlesticks. This is what we call the candlestick. All right, this is what we call the candlesticks. So the candlesticks, we have the okay, let me use this. You have the green candle and the red candle. Based on the settings that I gave you yesterday, you have the green candle, and then you have the candle and the red candle. Based on the settings that I gave you yesterday, you have the green candle, and then you have the. Are you sure you are seeing my screen? And the red candle. Based on the setting that I gave you yesterday, you have the green candle, and then you have the. Are you sure you are seeing my screen? And the red candle. Based on the setting that I gave you yesterday, you have the green candle, and then you have. Are you sure you are seeing my screen? Can you see my screen now? Can you see the screen now? Can you see the screen now? If you can see the screen, please just okay. All right. All right. So let's continue. So we have this candle, which is is the language of the market. And the more you understand the candlestick formation and based on the area of interest is what we're going to be sharing later, you'll be able to get into the market understanding candle, because the candle is the price represent period of time, the price movement representation. A candle represent how price has moved within a given time in the market. So you have the time frame, you have 5 minute time frame, you have 15 minute time frame, you have 30 minute time frame, you have 1 hour time frame, you have 4 hours time frame, you have a daily time frame, you have the weekly time frame, then you have the monthly time frame. Okay, and so some people also have 2 hour time frame actually. But so if this is 1 hour candle, it tells you how price has moved within 60 minutes. If this is 4 hour candlestick, it tells you how price has moved in 4 hours. So it's a representation of price movement within a given time. And so this is the bullish candle. How do you know a bullish candle? It's not just because of the color. Okay, that's why I showed you the black and white before, and I'm also showing you the green and red. So when the price close above the opening price, when the price opened and closed above the opening price, it is said to be a bullish candle. That means the opening price is lower, then the closing price is above the opening price. So it's a bullish candle. Now, when the price opens and closes below the opening price, it's said to be a bearish candle, a bearish candlestick. If this is open, if the price opens here, and when it is closing within that given period of time frame, if it closes lower than the opening price, it is a bearish candle. So it will appear red based on the setting I gave you earlier. Don't forget that you can use any color you want. Some people use blue and red. Some use white and black. Some use any color, is your choice. It's not really about the color. It's about understanding the opening and the closing price. So when the closing price is above the opening price is a bullish candle. But when the closing price is lower than the opening price, the bearish candle. So the candle has the body. The body is the filled part of the candlesticks. So and then it has the wick. It has the wick, it has the upper wick and the lower wick. There are candles that may not have wick at all, and some they have small wick, some will have big wick. And the candle that has small bodies, it all depends on the anatomy and the price movement within that period of time. We're going to consider my 20 reversal candlestick that will change your life forever. My goodness. By the time I teach you all these candlesticks, the 20 of them, it will blow you. You will make profit like crazy from the market. So we are taking it gradually. I have 40 minutes to go to gym. I have 20 minutes to go to gym. Okay. So now this is how the candlestick look like. Then let's look at the next slide. My next slide there, I have a candle. On this particular chart now, blue and red are being used as bullish. So the blue here is the bullish candle, then the red here is the bearish candle. Okay, and if you look at it, this is the opening price. Then the price closes above the opening price. The price closes above the opening price. Therefore, this is the bullish candle. And then here now, the price opens here and closes below the opening price, the bearish candle. So this is how candle looks like. And it has anatomy of candlesticks, as in the language, the representation, what it means with time, and based on where it is being formed is important. So let's look at this now. Let's say here now, let's assume this opening price here, let's assume this is the opening price, 1.4007. 1.4007. Let's assume that is the opening price. And then the price closes at 1.4077. 1.4077. Okay, price closes at 1.4077. Now, the difference between the opening price and the closing price, it is the number of pips by which the price has moved. The number of pips by which the price has moved. Let me see if I can get calculator on my screen. So if we do the mathematics, if we do the mathematics of so if you do that calculation, I already bring up the calculator, the responding. And so okay, so let's look at it there. 1.4077 minus 1007, 1.4077, and that will give us how many pips? 70 pips. 70 pips. 1.40 sorry 407 minus 1.4077. That will give you 70 pips. 70 pips. Now the pip is always in the 4 decimal places. In 4 decimal places. Like you can see, the pip is always in 4 decimal places. So you see something like this. You see that 1.400 here, the 5th digit here is called pipette. It's called pipette. So when you see it on your chart, on your right hand side that shows the price, it's called pipette. It's like the decimal point of pip. So if this price that you are seeing on my screen now, if it moves from 1.40010, by how many pips has it moved? It has moved by 9 pips. If it moved from 1.300, that means 1. So this is the last digit you see on your screen. I mean the fourth decimal place that shows the number of pips by which the market has moved. And but then if you have the JPY, if you have JPY pairs, they are usually in 2 decimal places for the pip. Then the third one is the pipette. 2 decimal places. When you have any currency pair with USD JPY, usually end into the last 2 digits shows you Y. This is USD JPY, and it's showing the last 2 decimal other then in any currency pair of that JPY is usually in 2 decimal places, and then the third one is the pipette. The third one is the pipette. Okay, so let's rush it. So let me move further. Price has moved by 70 pips. This has moved by 70 pips. Now we have 3 main lot sizes. We have the standard lot sizes, we have the micro lot size, then we have the mini lot size. We have the mini lot size. The standard lot size, which is 100,000 times the base currency, 100,000 units of the base currencies. And then we have the mini lot size, which is 10,000 units of base currency. Then we have the micro lot size, which is 1,000 times the base currency. And understand here that when you are trading in lot size, in a standard lot size, 1 pip, the price per pip $10. So per pip movement is $10. Per pip movement is $10. And if you are using per pip movement is $1. Per pip movement is $1. And then if you are trading in micro lot size movement, you have 10 cents. You have 10 cents. So now let's assume that price has moved in that direction. Price has moved by 70 pips, like we're talking about. So if somebody entered that trade now on 1.0 lot size, on one standard lot size, what will have been his profit? And then we add 70 pips movement. That means the person will have earned 70 pips times 10. So his profit will have been $700 as profit. $700 as profit. And then if you are moving, if the person has opened with a mini lot size, and then the price has moved by 70 pips, what do you think will be his profit? His profit will be 1 times 70. His profit will be $70. Then if somebody has mini lot size is this is 1.0, this is 0.1 lot size, and this is 0.01. So the lot size here on the standard lot size is 1.0. 1.0. And if you're trading with 1.0 on the price per pip movement will be $1. Not for gold, though, I beg. It's just for currency, especially USD. You know, the price per pip movement is $10. And then if you are trading with this one, it will be 0.1 lot size, you'll be having 0.01 lot size, 0.01 lot size, 10 cents. And then if you are trading with 0.1 lot movement will be $1. And if you are trading with standard lot size, the price per pip movement will be $10. And then so we may be trading the same instrument, the same or losses at the same time, is because our lot sizes are not the same. Our lot sizes are not the same. So a standard lot size is 1.0 and price per pip movement on normal currency pair, GBP USD, and then the price per pip movement will be $10. So if you have, just like I showed you now, if you have 70 pip profit, and you are trading 1.0 loss size, your profit will have been $700. And if you are trading with zero, and you have made 70 pips profit, your profit will be $70. And if you are trading with 0.01 loss, which is the nano, this is the micro lot size, your profit will be your profit will just be $7 because 0.01 times 70. We also have something we call the nano lot size, which is 100 times 100 units of the base currency, and that will be 0.001, which is 1 cent. So the person will have come out of the market with 70 cents, 70 cents out of the market. So that is where the lot size come in. That's how to calculate your lot size. You just look at your chart. If you are using computer, if you are using a laptop, there's a way you can drag your cursor. Don't worry, I'll teach you all of that later. You drag your cursor from the beginning to the end. It will show you in it will show you in pips, okay? And then you can calculate it even without having to use calculator and the like. So now let's come to this place. This is where it is getting more interesting. This is where it is getting all right. Beautiful. It's already shown on the screen. And so we have 3 market patterns, or 4. Let's say 4. We have 4 ways by which market moves. Market moves. I did not say chart pattern. I said market pattern. They are not the same thing. Market patterns. And so market can move up. Market can move down. a market can move sideways. These are the only three market you can trade. The first one here is called a bullish market, uptrend market, bullish market, bullish market. And so when you see market going to the upside, you see, when you see markets going to the upside, that's not about knowing many things. It's not by knowing 1,000 things. It's by knowing one thing in 1,000 ways or 1,000 times. So this is a bullish market. So when the market is forming, this is high, this is low. This is high, this is low. This is high, this is low. When the market is forming, and this high is higher than this high, so it is called the higher high. This high is higher than this high, it's called the higher high. This is low, compare with this is high, this is low, this is high, this is low. This low is higher than this low, is called the higher low. This low is higher than this low, is called the higher low. So when the market is forming a series of higher highs and higher lows, it is said to be in an uptrend, period. It's said to be in an uptrend. And therefore, I'll be looking for the opportunity to buy. I'll be looking for the opportunity to buy. When the market is forming a series of higher highs and higher lows, it is said to be in an uptrend. Therefore, I will be looking for the opportunity to buy. And this is a bearish trend. This is a bearish trend. It's a bearish trend. So the market is forming all right. Sorry. So we have the bearish trend. You had a bearish trend. When the market is forming series, now on the bearish trend, you have the high, you have the low. You have the high, then you have the low. You have the high, then you have the low. Now, this is high, this is high. This high is lower than this high. It's called the lower high. This is high, this is high. This high is lower than this high. It's called the lower high. Then this is low. This is low. This low is lower than this low. It's called the lower low. This low is lower than this low. It's called the lower low. So when the market is forming a series of lower highs and lower low, it is said to be in a downtrend. Therefore, I will only look for the opportunity to sell. That last statement is $1 billion statement. $1 billion statement. And then we have the ranging market. It's called sideways market. It's called the ranging market. Now, when you see it's forming, when the price is moving between a fixed resistance and support, when the price is moving between a fixed resistance and support, when price is moving between fixed resistance and support, it is called a ranging market. Therefore, I will buy at the I will sell at resistance and I will buy at the support. I will buy at the support, I will sell at resistance. Don't forget those statements. They are the secret to see. There is nothing, they are the most powerful statement, powerful understanding in the financial market. Why did people lose so much today on gold? It is because Okay, don't let us go there yet. Let us go there yet. But that simple truth is what we change, is what will make you profitable in the market. Now let me take you to the next slide. You see something like this. This is when you look at the chart and you see something like this. The market is bearish. It's a downtrend. It's forming series of lower high and lower low, 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 lower high and lower low. And therefore, here, look at what I wrote below here. We shall be looking for opportunities to sell. Opportunities to sell. Never try to buy in this kind of market. Don't try to buy. As simple as that statement is, it is different between those who say Forex is a scam and those who are making profits consistently in the market. That is the difference between them. Because you see, if you buy in this kind of market, you're going to lose money. Definitely, you're going to lose money. No doubt. Okay, you try to buy in this kind of market. Okay, you're going to lose money in most cases. See, you can skillful do it. Of course, I skillful did it today. We only bought gold for just for a few minutes. We scalp because the market was generally was selling, but just scalp to buy. Don't even try it in the next 2 years if you're a beginner. Each one is even 2 years. Don't even try it at all. Don't try. Don't try to buy in a downtrend, and don't try to sell in an uptrend. Okay, so when the market is, when you are seeing some, when you open your charts and I see something like that, how do you know the beginning? Maybe that, how do you know the beginning of a downtrend? Maybe that will be the class for tomorrow. This is when this is when you are a trader. This is when you are now like a trader, when you know when the trend has turned to the upside so that you can catch the wave from the beginning and ride on it. I'm telling you, I'm going to be showing you that subsequently. So now let me take you to the next slide. And when you have a market like this, when you have a market like this, when you have the market forming series of higher high and higher low, 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 higher and higher low, the market is said to be in an uptrend. Therefore, you should look for opportunities to buy. Only the opportunity to buy. And how do you get those opportunities to buy? That will be another day's topic. We are moving gradually. We're moving gradually. That will be another day's opportunity where you can come in every day and make profit every day on the same trend. You just come in day in, you are making profit. Tomorrow you come in again, you see signal, you enter again, but you are just doing the same. You're just following that trend, following the trend. I told you trend is your friend. I told you yesterday, trend is your friend. The moment you are working against the trend, you are blowing your money. Nothing blows money like when you are trading against the trend. I am not skillful about it. And so, on the kind of trend like this, on a kind of movement like this, so you have this movement, in a way like this. It moves up. Oh, sorry. It moves, then it comes down, then it moves up, then it must break the last resistance, but then it must not come lower than the last swing. It must not come lower than it. And so it goes up again. And it must break the previous resistance. It must not come lower than this. As long as it doesn't come lower than that, the trend is still sustained. The trend is still sustained. It is still to the upside. It's still sustained. Now, so when you see something like this, the longer side is called the impressive movement. Impressive movement. The shorter side is called the pullback or the retracement or the correction. So I have impressive movement, pullback, retracement, or correction. Impressive movement, pullback, retracement, correction. Impressive movement. So the direction of the impressive movement is the trend of the market, so you can see it moves up, it comes down a little, moves up, come 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 down a little, moves up. So it's an uptrend. The longer side, the direction of the longer side is the trend of the market, direction of the longer side. And then we have the same thing for for a downtrend. You are seeing impressive movement, you have a pullback. Impressive movement, you have a pullback. See, this pullback must not go above this. This pullback must not break this. This pullback must, when it breaks that, it tells you something is about to change. It must not go above this. It must not go above this. It must not break the previous resistance. It must not break the previous resistance. And it must, so the direction of the impressive movement is the direction of the market. So we have the impressive movement. See how this one goes here. So it comes like this, then it goes up, then it comes down, then it goes up, then it comes down, then it goes up, then it comes down, then it goes up, then it comes, and like that. And so, so we have the impressive movement like this, you have the pullback. You have the impressive movement like this, you have the pullback. And so some people will now, how do people lose money? By trying to buy here, because you don't know how long this pullback is going to be. And so people that say forex is a scam is because they are trying to buy here or trying to buy somewhere around here. They don't know how to take advantage of the impressive movement and then come out of it. And so how does a professional, let me tell you the secret. The secret of a professional trader is that he has the skill to enter at the beginning of an impressive movement and comes out before the end of it. He entered the market at the beginning of an impressive movement and comes out before the end of it. He entered the market at the beginning of an impressive movement and comes out before the end of it. He entered the market at the beginning of an impressive movement and comes out at the end of it. So how does a day trader actually trade? A day trader, let me quickly show you how a day trader will trade. A trader, we have a skill to enter at this point. I wish I can switch window. Okay. Just bear with me how this thing looks like. It will enter here, and then guess where his take profit will be? His take profit will be before. That's the only thing he's sure of. He's sure that if I can catch the wave at the beginning of this impressive movement, and then before it ends, lower. But he knows that it will reach this place. Okay? Those are day traders. So between here and here, in just few hours, they already have. We enter at the beginning of an impressive movement like this. Okay? Impressive movement like this. Okay, like now, it may be trading support and resistance here. If we enter at the beginning of an impressive movement like this, and then it comes out at this place, that's all for the day. Is off. By the time this market get here and its take profit that we eat is out of the market, for that day, is out of the market. So it enters again another day, it come back the following day, enter the market from here, enter the market from here, from this spot, and then it comes out before it ends, before this break to the previous support, then it's out of the market again. It can be heading like that, coming in and coming out, coming in and coming out, coming in and coming out, coming in and coming out. But see, a swing trader is different. A swing trader gets the beginning, it enter the trade at the beginning of the swing. A swing trader will literally be entering the trade around maybe somewhere around here. Somewhere around here. That's where a swing trader will enter the trade. When enter the trade around here, so what does it do? What does it do? At the next support or something, it will just be trading in stop loss. So you'll be moving the stop loss. When the market move from there, move down, you move the stop loss. When the market move down again, it will move the stop loss. It will move the stop loss. It will be trailing it. We call it trailing the stop loss, until the swing changes. That's the swing trader. A day trader enters at the beginning of an impressive movement and close before the end of the impressive movement. But the swing trader enters at the beginning of the swing and comes out at the end of that swing. So why this guy is opening maybe one position or two positions, this one is coming in every day or every 2 days to, as soon as I see opportunity to enter again, how to get this opportunity to enter is what we're going to be teaching in the subsequent classes. Then we have, Just the same thing here. You enter at the beginning of an impressive movement and comes out at the end of it. Enter at the beginning of an impressive movement, comes out at the end of it. Enter at the beginning of an impressive movement, come before it ends, comes out before it ends. Enter at the beginning of an impressive movement, comes out before the end of the impressive movement. But the different case is from the swing trader. The swing trader will enter maybe somewhere around here, and then it will be following it until the swing changes direction again. That's a swing trader. That's a swing trader. And so the same thing, it's a different ball game when you meet a ranging market. Oh, I didn't tell you the fourth kind of market. Don't worry, let me finish this one. So on the ranging market, all right, I think it's showing now. Oh, I'm waiting for it to show on the screen here. Is it still lagging? I want to show my ranging market. I want to show my ranging market. Oh boy. Why is it lagging here? All right, so if you have to follow, enter the beginning of an impressive movement, comes out before the. If you have to follow, enter the beginning of an impressive movement, comes. All right, now this is the ranging market. Trading a ranging market is a little bit different from trading a trending market. A trending market. This is a ranging market. It's called sideways market. The price is actually juxtaposing between a fixed resistance and a fixed support. A fixed resistance and a fixed support. So what do I stand? Opportunity to buy at the support. I sell at the resistance. I buy at the support. I sell at it. Look at what I was telling you yesterday. History repeating itself. For example, price got to this place and came out and it was rejected. So I'll mark it in the future. History is repeating itself right now because it was rejected here. It got to the same price in the near future. It was rejected again. History repeating itself. Then look at it here. Look at it here. What we were saying yesterday. History that happened here, it is happening here again. It is repeating itself. Price got to the same resistance, the same price it got to in the past, and then history repeated itself. It was rejected again, and the same thing happened here. Look at it here. Price got to this place, to this support. It was rejected to the upside. It rallied up, and the price got to the same place in the future and was rejected again and went up. That's history repeating itself. I told you don't forget those two statements I gave to you yesterday. Number one, trend is your friend. Number two, history repeats itself, or history has a way of repeating itself. History has a way of repeating itself. And so now, this is the next thing I want to share with you. How do you trade a trending market? Because the strategy to trade trending market and the strategy to trade ranging market, they are not the same. They are not the same. They are not the same. How to trade trending market? There are strategy to trade trending market. The moving average, the EMAs. You use EMA to trade trending market. Then you use Fibonacci to trade trending market. You use ADX to trade trending market. And I'm already late for the gym. Just let me quickly show you how to use a moving average to trade a trending market. Let me share my screen with you. I'm just going to give you the setting. Then I'm going to rush to the gym right now. I've missed gym for 2 days now because my coach was writing exam. All right. Let me quickly share my screen with you. Let me share this screen with you. I'm going to give you the setting, then we're going to practice it together. Like that. So, and I'm going to be sharing you another screen. I'm going to be sharing you another screen. All right. Can you see my chat now? Can you see my screen now? All right. Can you see my screen now? Can you see my chat now? You can see my chat. Please type 3 in the comment section. Can you see my chat now? Please type 3 in the comment section. Oh boy, I'm already late. So let me quickly, is somebody typing 3? Can you see my chat? If you can see my chat, please type 3 in comment section. Type 3 in the comment section. All right. Is someone seeing my chat there? Can you see my screen? All right. Somebody is already seeing my screen. So let me quickly do this. Let me quickly do this. Let me quickly do this. All right. So now I want you how to use moving average because I see that all over the world, I see some people still use this strategy. And let me tell you this. This is how I started trading. This is how I made my first set of profits in trading financial markets. Okay, in those days when I did not know price action, when I did not know anything candlestick, this is how we started to trade. This is how I made my first $400 in trading forex. This is how I make years back. Years back, I made my first $400 in trading this market. So what do? I want to give you it's like a cheat. I only do that today, like a cheat. Then subsequently we'll go to price action. But this is one way people can trade a trend market. Now it is discovered, it is find out that market trend for 40% of the time. 40% of the time, markets stay trending. I mean, instruments stay trending. But then there are some instruments that stay long trending much more than any other instrument. For example, gold. Gold trends a lot. If gold is buying well. If gold is selling well. So if you want to use the trend trading strategy to trade an instrument, you should be able to look out for instruments that stay trending the most, that stay long trending. Okay. Look at instrument like gold and look at Nasdaq USA 100. In fact, that's the one on my screen right now. It trends a lot. It still trending a lot. So let me give you the setting of the moving average. In SAT, you go to your insert, then you pick indicator. Under indicator, you pick trend. Then under trend, you pick moving average. So you set the first one. The first one is 10. Then method, you pick exponential, apply to close, style, red. Maybe I'll do a different video for this because I need to rush out now. Then you click enter. Then you see a red line showing on your screen. Then I'll go to the place again and I'll tap and then exponential, shift 0, apply to close, style. My color this time around is blue color. Then I give it a thickness. Then I say enter. Then I'm seeing a blue line on my screen. I'm seeing a blue line on my screen. A blue line has appeared on my screen. And so I come again. I want to insert the third one. The third one is indicator, trend, moving average, then 200. This time around, the 200 is black color. Exponential, apply to close. This time around, the color is black. Then it has given me the 3 colors. I'll give me the 3 colors. So what is the strategy? The strategy is this. Actually, this thing is showing like this. So the strategy is it showing? I can't see your screen no more. I don't know why the screen is not showing again. The strategy is it showing? I can't see your screen no more. I don't know why the screen is not showing again. The strategy is showing? I can't see your screen no more. I don't know why the screen is not showing again. Is my screen showing now? All right, don't worry. I'll record a video to show you that. Okay, I think it's showing now. I think it's okay. Let me quickly repeat what I said. I need to get to gym today. As my coach will talk. Now, So I said, okay, I did there, then do it again. I said insert. You want to insert indicators. All of you have indicator on your phone and on your computer. You know, it comes with your MetaTrader. So I still insert, then indicate, then moving average. So the first moving average I'm doing is I'll put period 10, method exponential, apply to close, style, the color is red. Then I click enter. Then I go back again, insert, indicator, trend, moving average. Then I put 50. The period is 50. This time around, the color is blue. The color is blue. I click insert. Then I go to insert again. I say trend. I said indicator, trend, moving average. I click moving average. Then this time around 200 exponential, apply to close. This time around the color is black. Look at it. The color is black. So I zoom it in. So what is strategy? This is how I made my first $400 many years ago. Many years ago. I don't trade this way again, but then it can help someone. It's usually good, it's applicable when you are when the market is trending. This thing work like magic. It does not work all the time, especially in the ranging market. It does not work in the range of money. You're gonna make a lot of money. This is not how I trade. That's just making money. Every time I teach in physical class, day 2, I always so when the red line cross the black line, when the red line cross the black line from down up, buy. When the red line crosses the black from down up, buy. Look at it, it is buy. It is buying. Then the statement 2, when the red line crossed the blue line from up down, sell. See how it is still selling? See how it is selling? That's statement 2. Statement 3, when the red and the blue line cross the black line from down up, buy. It's a very strong buy. Very, very strong buy. Very, very strong buy. And then the fourth statement, when the red and the blue line, that's EMA 10 and EMA 50, when they cross the black line from up down, sell. And that's it. So don't worry, I'm going to record a video as soon as I come back from the gym to further explain this thing. I'm going to be adding ADX to it. You will make money. You will love it. You will love it. All right, at this juncture, let me quickly come out of this class, and then don't worry, just go to what we have shared in the class today. You can watch the video. Make sure you subscribe, just like my boss says, so that they will not change. I don't want them to change the teacher of CHICS in Trade. Please subscribe, and then I'll see you when I come back from the gym. I'll record the video for you as soon as I come back from the gym. Thank you.